give us a sense of how inflation and the interest rate hikes have affected you personally and your family?
Look, it has been an intense year. It's been a year of focusing on getting inflation back down. What I will say is that I am confident that our framework works. We have raised interest rates rapidly. We are starting to see the effects of that, and I am confident inflation is going to come down. But what I am particularly preoccupied on is this has been a very difficult year for Canadians. Canadians are feeling high inflation. High inflation, it's everywhere. It's in your groceries. It's in your when you go fill up your car. It's in your rent. These are not things that these are everyday items. There's no way around inflation, and so Canadians are really being stretched. And then the other part of it is we've raised interest rates rapidly, and yes, that is working, but it is creating strain for some Canadians, and that is difficult. We are going through.
Do you buy groceries yourself?
Yes, I do buy groceries myself. Yes, and when you get to the cash register and the whole thing adds up, yes, it is definitely noticeable. It is higher. All I can say is that we are in the midst of a difficult transition, but it is going to work. Growth will be restored and inflation will come down, and we're not going to sleep easy at the Bank of Canada until we get there.
We'll go next to CBC.
Thank you. Obviously addressing a room full of business people, what would be the biggest takeaway for average Canadians who will be listening to this response from your speech, particularly looking at next year?
I think the biggest takeaway looking forward is that we know inflation is too high. We've acted forcefully to bring the economy into better balance and bring inflation down. When the snow melts, when we get to the spring, we should see much clearer evidence that inflation is moving down. And yes, we are going through a difficult adjustment. The economy is slowing. We expect it's pretty much stalled, but we will get through this. Growth is going to come back. We expect in the second half of the year, and inflation is going to come down. And what that means is that Canadians don't have to live with the anxiety of high inflation.
We're going to move to the phone lines, and if we have time, we'll do a second round. We're going to go first to Paul Vieira, followed by Steve at Reuters, and then Rob. So go ahead, Paul.
Governor, you've said you said in the last month that the unemployment rate at near record lows was unsustainable and would need to rise for it as the bank looks to contain inflation. The unemployment rate dropped again in the most recent month's data. What happens if the unemployment rate does not either climb or there isn't enough slack created in the labor market as you would like to see?
Well, look, I think the short answer is that if the economy remains overheated, if the labor market remains very tight, we're not going to see the needed reduction in inflationary pressures, and inflation is not going to come down, or certainly not come down enough. I will say that we are starting to see some improvements in the balance in the labor market. Vacancy rates have come down, but as you underlined, we continue to see very tight labor markets. We continue to hear from businesses that they're having trouble hiring the workers they need to meet the demands of their customers. And that's been an important reason why we've raised interest rates. Part of rebalancing the economy is getting the labor market into better balance.
Thank you. Steve?
Thank you.
Hello, Governor. Last week, after the interest rate increase, you indicated that further changes to the level of interest rates would be data dependent. But at 4.25%, rates are firmly in restrictive territory. And I was wondering if you could speak to how long you see rates needing to be restrictive.
Well, as you highlighted, last week we raised by 50 basis points. We indicated that we would be considering whether interest rates needed to rise further. And yes, what does that mean? It means, going forward, our decisions about whether we need to raise rates further or whether it's time to pause are going to depend importantly on incoming data. We're going to get quite a bit of data before our next decision. And we'll really be looking at that through the lens of, what does that mean for the outlook for inflation? And as I mentioned in my remarks today, we're really trying to balance the risk on the one hand of we don't want to over-tighten. We don't want to put the economy through a more painful slowing than we need to. On the other hand, we don't want to under-tighten, because if we under-tighten, inflation's going to stay too high. Canadians are going to have to continue to endure the hardship of higher inflation. And ultimately, we're very likely to have to raise interest rates even further and have a sharper slowdown to get the economy, to get inflation back. So yes, we're trying to balance those two risks. The risk of not being sufficiently committed, not doing enough. Given where inflation is now, given that inflation is well above our target, that looks like the bigger risk.
Thanks. We'll go to Rob.
Hi, Governor. If you look back at all rate hike cycles of 100 basis points or more since the Bank of Canada started inflation targeting, it's taken a little over 5 months on average after the overnight rate peaked before the Bank of Canada started cutting rates. So we all know that inflation is going to get back to target at some point. But given that inflation seems to have more momentum in this cycle than probably any time in the last 4 decades, how much does that momentum increase the likelihood that it could take longer than average this time before rate cuts are warranted?
Well, I'm not sure I totally understand your question, but I think what you're asking is something along the lines of, how long do rates have to stay high? Look, I think sort of building on my last answer, what I'd highlight is, look, we have raised rates. We have acted forcefully. We've raised rates 4 percentage points since March. We're starting to see the effects of that on the economy. That is going to pass through to lower inflation. We're going to be looking at incoming data to determine whether rates need to rise further. And in terms of how long they're going to rise, well, we're going to take those decisions one at a time as we move forward. But what I would highlight is that inflation is well above our target, and it is a long way back to our 2% target. And as I underlined in my remarks today, we are resolute in our commitment to bring inflation all the way back to 2%.
So next on my list, I have Stephanie Hughes, followed by Mark Rundle, and then Ian Bickus. So go ahead, Stephanie.
Hello, Governor. Thank you for taking my question. I was just wondering, how will the central bank assess if all of these forces you've mentioned, the shorter supply chains, vulnerable business relations between countries, economic shocks, would make getting back to that 2% target too costly? Could the Bank of Canada have to consider a new target, or should Canadians get comfortable with inflation that is higher in the comfort zone rather than just below 2%?
Well, our mandate is very clear. Our mandate is to achieve the 2% inflation target, and there are very good reasons why the target is set at 2%. And, the short version is when inflation is 2%, Canadians don't really need to worry about inflation. They can get on with their lives. They don't need to worry about the substantial increases in their cost of living. If we were to to not get inflation back all the way back to 2%, Canadians would have to continue to deal with the anxiety of inflation. They would have to continue to worry about inflation. They'd have to continue to worry about, stretching their paychecks to cover their bills. 2% inflation was not chosen haphazardly. It is important. You want inflation low enough that Canadians don't have to worry about. So, they can focus on their spending and savings decisions. They can get on with their life. So that's our mandate. We think, a great deal of thought has gone into the mandate. It's been reviewed every 5 years since it was first established. The target has stayed through that whole period at 2%, and that's for good reason.
Go ahead, Mark.
Thanks. Thanks for taking the question, Governor. Mark Rendell with the Globe and Mail. A couple of weeks back, your predecessor, Steve Poloz, said in a speech that he thought rate hikes might be more powerful today than they've been in previous rate hike cycles, largely because of higher levels of debt throughout the economy. I'm wondering, do you share that view on rate hikes being more powerful than in the past? And if so, what does that mean for the speed with which economic activity could drop next year and inflation could come back to target?
Well, there's certainly a case to be made that they could be stronger than in the past, and the main reason for that is household indebtedness has increased considerably since the last time interest rates were this high. So when households hold more debt, the impact higher interest rates have on servicing that debt is bigger. So there certainly is potential for it to have a bigger impact. There are some counterbalancing factors. Through the pandemic, Canadians were unable to buy many of the services they wanted to consume, restaurant meals, vacations. And so some of that money that they would have spent on those things got saved. So they have, many Canadians have some sort of what economists call excess savings. So that may provide somewhat of a buffer. But yes, overall, I think it is plausible that interest rates could work a little faster than in the past. And that is something that, we are certainly looking at and taking into account. And in my remarks, I mentioned that, we do have new data sets that allow us to, see at a more granular level how higher interest rates are impacting Canadians. And so we will be looking at that data. We'll also be looking, importantly, at our survey data on the business side to see how businesses are adjusting to higher interest rates.
Ian?
Thanks, Governor, for taking my question. You outlined in the speech several lessons learned this year, mostly around surprising inflation to the upside. I was wondering how you plan to apply those lessons going forward, and if you'll be more cautious before lowering rates, given how inflation has acted this year, or just in general how you plan to use these lessons.
Yes, it's a good question. How are we taking on board the lessons that I highlighted? Look, I'd say three things. First of all, as I've mentioned, we're looking at new types of data. So, for example, on supply chains, we're very alive to the realities that supply chains they're very complicated, they're tightly coupled, and so we've created a dashboard, or what we call a heat map, actually, looking at a whole range of supply chain indicators to try to help us measure how quickly they're resolving. And certainly what we see is that, many of those measures, have turned from red to yellow, and some of them are now green. You look at, shipping backlogs, shipping costs, for example, time to delivery, those things have really improved. Some other elements have been a bit slower to improve. When you actually talk to businesses about what they're seeing, I would say you get a slightly more mixed response. And what I think that reflects is that if you're a business and you have a supply chain, if you're missing one piece can really clog up your whole production. But we do expect to see some continued improvements there. So I also mentioned some other types of data that we're looking at. The second thing I would highlight is that we're also enriching our models to take greater account, for example, of things like network effects. So, you can take the input-output structure of the Canadian economy, and you can look at the economy at a more granular level, and then you can see that, well, if this input that comes from somewhere else in the world is not getting delivered, how does that feed through to how does that feed through to the Canadian economy? And then the final thing I'll highlight is being better listeners and also better communicators. We've, for many years, had our Business Outlook survey. We've recently supplemented that with a Business Leaders Pulse survey. That's a digital survey. We can do it more frequently, and it actually gives us better reach into small and medium-sized companies. So we're supplementing our Business Outlook survey with this new Business Leaders survey. And then finally, on communication, I think we've been out there more than usual. I think there's a good reason for that. Canadians are feeling high inflation. They're feeling higher interest rates. It's really important that Canadians understand the decisions we're taking. We know that the more people understand how monetary policy works, actually, the better it works. So we've been communicating more. We've been using different channels. We've been using social media, for example. It is increasingly important that we communicate to Canadians where they want to receive their information.
Okay, so we are almost at time, but we have just one reporter left on the phone. So go ahead, Eric.
Hey, good afternoon, Governor. This is Eric Hertzberg with Bloomberg News. Forward guidance has been an important part of your toolkit this year, so reflecting upon that, should we expect that you would provide forward guidance to Canadians about the duration of a pause in interest rate movements once we get there? Would you explicitly signal a pause?
Look, I think, first of all, I'm not going to speculate on what we might do in the future, but when we were at the effective lower bound, we used exceptional forward guidance because we couldn't lower our interest rate any further. And exceptional forward guidance is when you're in these very unusual circumstances, you're at your lower bound. Exceptional forward guidance is something that's in your toolkit that can, by indicating rates will stay low until the output gap was closed, that help hold longer-term rates down. That was important to supporting the recovery. Last January, we moved off exceptional forward guidance, and yes, we're certainly telling Canadians how we see the economy. We're telling them, what our outlook for inflation is, what the risks around that for inflation, and what we see the implications are for interest rates. But I'm going to leave any future decisions to the future.
So unfortunately, that is all the time we have for today. So thank you to everyone for taking the time to come and participate. Merci. Bon après-midi.
Thank you very much. And